Yes, we are live again. So let me share my screen. Yes, so this is where we stop, right? We will now go on to bill and hold arrangements. Now, what exactly is bill and hold arrangements? Okay, what exactly does it? What do you mean by bill and hold arrangements? Now, what is bill and hold? Bill and hold arrangements. What it means is that there could be an instances where, let's say that X is the seller, okay, and Y is the buyer. Now, they might have had entered into a sale contract, and the sale contract would have been, done. The X would have made ready the goods that is needed to be supplied to Y. Everything is done, and they have made the invoice also. Okay, they have billed. But why says, okay, hold on, the thing is, like, in my factory, in my warehouse, there is a strike, or there is a natural disaster, or there is some political tension that is happening. We saw political tensions during in Bangladesh and Nepal recently, right? So there are something, extraordinary act of God slash uncontrollable things that is happening in this place. So what you do is, boss, you just keep it with you. Okay. I know it is our product, but just keep it with you. So just hold on. Just don't make the delivery. You bill, you'll pay, you kind of like, keep it with you for some time till my tensions are gone, and then you deliver it. So this is called a bill and hold arrangement, where the seller will bill and hold on the specific recommendation of the buyer. Now, in such an instance, do you think that X can record a sale? Do you think that control is transferred to Y? Or do you say that the actual delivery is not completed, it's still my warehouse, so it is not transfer of control? What would be my notion? So IFRS says that control is indeed transferred. Okay, we are keeping it here in our warehouse due to the specific request or the specific instructions of the buyer. Okay, so that means now the risk and rewards and the control is transferred.
Bro,
He is taking
playing
the
biscuit.
onus. And can you mute yourself, please? He is taking the onus, and he is asking X to keep it in his warehouse. So in such a case, this is a sale only. Okay, even if the goods are not left your warehouse, it's still a sale. And when it comes to performance obligations, you can choose to have a hold arrangement, that is, you're holding others people's goods, right, as separate performance obligations also. And you can charge him extra money also. But it does not take away the fact that uh, you know this is actually a sale. Okay, you can mark hold as a performance obligation, and kind of whatever is the amount that is allocated for hold in point number 4 has to be recorded only when it is delivered. But other than that, it's a revenue. Risk and rewards associated with the product is sold. So what I meant to say is that, let's say that the for this arrangement he's charging 1,000. Okay, and he is not charging Y for holding. Okay, but generally, while holding, you have to take the standalone price of holding, and you have to split between what is the amount attributable to the performance obligation of holding and what is the performance obligation regarding to sale. If you're charging separately for holding, then there is no need to split because we have another account as well. Okay, now this 1,000 you will record as revenue, then the control is satisfied and Y makes the request. And 400, which is the amount for performing the performance obligation of hold, can be recorded once the performance obligation regarding that is satisfied. That is, the delivery happens. Are you understanding bill and hold arrangements? Just because you're holding doesn't mean you have not completed the same. Yes or no? Okay. So be prepared to see bill and hold arrangements. Now, what are the indicators which show that there is bill and hold arrangements? We will see. So under bill and hold arrangement, goods are sold but remain in the possession of the seller for a specified period, perhaps because of customer lacks storage facilities, right? An entity will need to determine at what point a customer obtains control of the product. For some contracts, control will not be transferred until the goods are delivered to the customer. For others, a customer may obtain control even though the goods remain in the entity's physical possession. In this case, the entity would be providing custodial services, which may constitute a separate performance obligation to the customer over the customer's. For a customer to have obtained control of a product in a bill and hold arrangement, the following criteria. So, how do you know that the customer has got a control in bill and hold arrangement? You have to see this. The reason for the bill and hold must be substantive. That is, it should be requested by the customer. Okay, it should not be because you don't have, you have billed and you don't have means to deliver it. No, it should be requested by the customer. The product must be separately identified as belonging to the customer. Okay? The product must be ready for physical transfer to the customer, and the entity cannot have the ability to use the product or transfer it to another. So, if all these conditions are met, then it means that the control with respect to the product is transferred to the customer, and you can record revenue. Okay. For the hold, if you are kind of treating it as a separate performance obligation, that you record the revenue attributable to that you record once it is there. Okay. So let's understand. We'll take an example also. An entity enters into contract with a customer on 1st January 20x8 for the sale of machine and spare parts. It takes 2 years to manufacture these on 31st December 20x9. So that is 3 years afterwards. Year two, 2 years afterwards. Okay, the customer pays for both the machine and the spare part, but only takes physical possession of the machine. The customer inspects and accepts the spare parts, but requests that they continue to be stored at the entity's warehouse. Now, there are three performance obligations: transfer of machine, transfer of spare parts, and the custodial services. The transaction price is allocated to three performance obligations, and revenue is recognized as the control passes to the customer. Okay. So, hold can be a separate performance obligation. That's just what we are trying to say. The machine and the spare parts are both performance obligations satisfied at a point in time. And for both of them, that point of time is 31st December 20X time, right? In the case of spare parts, the customer has paid for them. The customer has legal title to them. The customer has control of them as they cannot remove them from storage at any time. The custodial services are a performance obligation satisfied over time, so revenue will be recognized over the period in which the spare parts are stored. Okay. So this is how you have to keep in mind bill and hold arrangement. The bill and hold arrangements, main point is the request should come from the customer to store goods at your place. Okay. It should be substantive. Any doubts on bill and hold arrangements? Perfect. Now let's go to sale with a right of return. Okay. Now I think this is going to be the last, duly or the permutation that we'll be doing. And but this is what I call as an examiner's favorite. They test this a lot. Sales with a right of return. So let's understand how this is going to be done. Okay. So what is sale with a right of return? What is sale with a right of return? Now, is this same as repurchase agreements? Let's see. So sale with a right of return means like yeah, the buyer, the seller is selling to the buyer. Okay, the buyer is not happy. If the buyer says, no, no, this is absolutely, I will be given a time, say 6 months or something. Until then, I can kind of return it back with full refund. Okay. So these are things which we see very commonly. This is not a repurchase agreement. The seller doesn't want to repurchase it, but it's always buyer who have a right to return. Okay. So it's not, don't confuse this with the repurchase agreements and having a put option for the buyer. No, this is not resale. See, the amount is going to be the same. It's just like, when you walk into a clothes shop and you have 2 days or 1 week. Like, if you don't like the fitting, you can come back and change it, or you can get a full refund of it. So this is what is this all about. Now the question is, when I sell something with a right to return, is this revenue? Is this revenue? Can I record revenue right away? So let's say that I sold goods worth rupees 10,000 with a right to return in 3 months. I sold, I billed, everything is done. Can I record revenue? What do you think, guys? Can I record it as revenue? In a repurchase agreement, we have said no. So here everybody, okay, somebody is saying yes, somebody is saying no. No, so people are saying yes. Okay. See, the thing is, you are not sure, right, whether you will get back or not. Customer may return it back, customer may not return it back. So in such an instance, there is a separate accounting treatment that we have to do for such goods which have a right to return. So what do we have to do? So first thing is you have to keep it as goods. So let's say that there are like you know 10,000, and let's say the cost of this is 8,000. Okay, this is revenue, and the cost of inventory that I have is 8,000. So the what IFRS tells us to do is that amount of revenue, you kind of like keep it separate. So what would be the entry which would come? So let's say that the customer comes and purchases for $10,000. What would be the entry? The entry would be bank account, bank debit to right to return liability. Okay, you credit it as a current liability or non-current liability. You will not credit it in revenue because it may come back. You can't recognize revenue unless you are 100% certain. So you will park it in a account called right to get back. So this is 10,000, right? You got the money. You have a right to return 10,000. So obviously, like in such an instance, the apart from the bank, apart from the money you receive, the inventory would also have gone from your account, right? So we have to park that inventory loss also separately. So we will write right to return asset to inventory. That is why I gave you the cost. So this item will be gone from our inventory, right? So we have to do an inventory credit as well and park it in, instead of sales, we are making right to return liability. Instead of cost of goods sold, we are in right to return asset. Okay, we will just park it in a completely different account. We will not record it as sales or cost of goods sold. Okay, this is the treatment when there is a right to return asset. Now, what happens? Now, let's say 3 months have elapsed. Okay, 3 months is the time given. 3 months have elapsed. Customer has not brought back the goods. Right, so he is not returned. So in that case, once 3 months have elapsed, now we are certain that revenue can be recorded because it's an outright sale now. So what I do, I will take this account, right to return liability to revenue. Okay. And of course, instead of right to return asset, I'll cost of goods sold to right to return asset. So inventory, which was lost, I mean inventory removed, which was parked in a separate account, now goes into cost of goods sold. This is when the customer does not return. Okay. What happens if the customer returns? Let's say within 2 months, customer returns the product. Then what do you do? Then obviously we have to give him money, right? So what you do is this right to return liability then is manifested. So it would be right to return liability to back. We will give him back the money, right? Now, with the bank amount also, he would also be returning the product, right? So product, once it was sold, we have parked it in right to return us. Now he has driven the product back. So that also we will be, instead of cost of goods sold because sale was not made, we will relate it to inventory into. Is this clear? Is this clear how you have to call? You don't actually show as an outright sale. You park it in accounts. There would be a right to return liability because we may have to return this 10,000. That's why it's called a right to return liability. And there is a right to return asset also because inventory is lost, but it has a right to be received back. So we are crediting as an asset. And based on the customer's behavior, we will be recording revenue or giving it back to the owners. Yes. So this is basically right to return. Now, sometimes what happens is this option we take when we don't have this is normal. Okay. Now, what happens is sometimes we sell a lot of products. No, we don't sell just one product. We sell a lot of products. When it comes to clothing or electronics with a right to return, is a lot. I mean, to too many customers. So what we do is we almost normally have an estimate of how many people will return, how many people will not. If I have a reasonable estimate, okay, which shows how much people will return, then I can book revenue to that amount and then book return, right to return liability only to the remaining. So what will happen is I will only show the change to this. So let's say that normally I've sold goods worth rupees 10,000. Normally 2% is the return. That happens. I have such numbers which is verifiable based on empirical evidence and such an estimate the auditor has no reservations to. Then I will record when customer purchases, I will record bank, bank I'll get 10,000. I will record revenue to the extent of 98% because empirical evidence only says 2% is return. So in such a scenario, I will record revenue forever and right to return liability would only be for the remainder. So this is a very risky accounting, but it can only be used if the auditor says, okay, this is a good empirical evidence of the return that has come. So it's an audit estimate. Oh, sorry, accounting estimate. Okay. So other than that, this would be how you should be dealing with right. return. Is that clear? Okay, fantastic. Now we will go ahead and read. When the goods are sold with a right to return, an entity should not recognize revenue for that good that it expects to be returned. It can calculate the level of returns using expected value method. That's what I told you. Expected 2% will return. The probability weighted sum of amounts, or simply estimate the most likely amount. This will be shown as a refund liability or liability to return and a deduction from revenue. The entity also recognizes an asset adjusted against cost of sales for its right to recover the products from the customers on the settlement of refund liability. This is right to return asset, right? Inventory, which will be coming back, we will record it as an asset. That's all that these guys give. They don't give the journal entry or anything, but you have to be very clear regarding how the unless you until you kind of get the journal entry, you will not understand the full essence of it. But at end of the day, like this may be tested. This is their favorite line because apart from all the other combinations and permutations we've seen, this is something which is very ordinary that happens in business, right? Sale with a right. You walk into any like you walk into Landmark, you walk into Splash, you walk into anywhere, you will see that can't we just record a sales return entry instead? No, see, the thing is, give if we kind of give customers the product without a right to sale, and if they come back and kind of return and we take those guys in because of our customer relationship, then it is a sales. Otherwise, see, this is very old. I mean, what IFRS says is like, when you sell, there is a right for the customer to return it back. No? So don't record it revenue now. You record it when it is reasonably sure that you will get back the amount. The same as what we are doing for contingent consideration also, no? For variable consideration as the case may be. If you remember, if I am not sure whether this consideration would be received or not, I will not record. I will record only when there is enough evidence or enough probability that the revenue that are recognized will not be reversed. So same parameter here, IFRS says use conservatism, prudence. Unless and until you understand, you are clear that this will not be returned, then don't record it as revenue. Right? Mathematics would be the same. That is revenue minus sales of goods, sales return would be there in the old style or in the current style where we are recording it differently. But end of the day, the presentation should be very clear. Okay, so IFRS is enhancing and making sure that unless and until you're not sure if there is a return, don't record the revenue at this point of time. You record it after 3 months. Okay, so this is how the accounting should be. And if you are recording as a sales return, that is not as per IFRS. Okay, right. So that those are the permutations combinations. We saw a lot of permutations combinations. We just have a kind of like we saw warranty. Warranty. What did we say? Warranty you should recognize as a separate performance obligation only if it has a separate standalone price. Okay. That is regarding warranty. Principal and agent, we saw the parameters when we will see whether it is a principal or agent. If agency means the revenue that is attributable to the agent is only the commission, and he will not be a dealer or a distributor. Okay, he will only be entitled to commission. You can show a revenue only when the control is transferred. Okay, these are the parameters which you have to see to understand if there is a principal agency relationship. Okay, repurchasable agreements, obviously this is not sales, right? If there is a repurchase agreement and if everybody can record it as sales, then everybody would inflate their revenue. And because what is happening is previously nobody used to look at revenue, they were all looking at profit. But now these internet companies have come who estimate their valuation on the basis of revenue, right? There are a lot of companies like Zomato, Swiggy in the Indian framework. What they do is they increase their huge losses. But what is done is the valuation is increased because we are getting more customers. We are using penetration pricing now, but we are kind of building the market. Now Kita is now launched in UAE and Kita is selling it, giving good orders. Why? To penetrate the market. Now once the market is penetrated, everybody is comfortable with this app, then the switchability is less. Okay. So they will show huge amount of revenue by getting into gimmicks like this. Increase their valuation, sell it to the next investor at a exorbitant price, and then he sells it to somebody else. So end of the day, if that is what the value that you intend to create, sorry, IFRS will not be coming to your help. We will say, unless and until if it is not revenue, don't record it as revenue. We will take substance over form and we will record it as something else. Okay. And consignment, of course, consignment is very important, especially from a UAE standpoint. You have to see if this is, when you recognize the revenue, when the control is transferred. And when will the control be transferred? When the consigner or the dealer or the supermarket guy sells it to his customer, right? So that has to be seen very importantly to recognize if you have to transfer the inventory to them or you have to record revenue with them. Very important. And of course, bill and hold arrangements. Hold can be a separate performance obligation altogether. Okay. Other than that, it is revenue. It's because you're holding it at the specific request of the customer and the goods and the risk and rewards and the controller transfer. He is telling you to keep it and it is his responsibility. So you can record it as revenue even though the goods are on your premises. And of course, sales with a right to return. Definitely don't include it as a revenue right away and show it as a sales return. This is to be recorded as revenue only when there is confirmation that it has not come back. Okay. So this is an overview of these things. Now let's look at presentation. Yes, presentation is quite okay. You have to show a contract liability for, advance consideration received, or else you have to show a contract. These are the examples of, obligations satisfied over time. Okay. So let's do that. Let's do that. It is not something new that you have done when it comes to a contract. Okay. Let's apply the principles that we learned in attempting this question. So let's see that suppose the contract is started on 1st January 20XY. Okay. 1st January 20XY, the contract is starting with an estimated completion date of 31st December 20X. Completion date of 31st December 20X6. So how much is it? It is a contract for Jan to December, and yeah, so it is a contract for 2 years. Okay, right. The final contract price is 1.5 million. So full contract price is 1.5 million. Okay, and cost incurred amounted to, so cost incurred till date amounted to 600,000. Half of the work was completed. Okay, and certificate, work completion certificate issued for 750,000. Of course, half was completed, no? So half of 1.5 million, 750,000, the certificate of completion was issued. It is estimated with reasonable certainty that further cost to completion would be 600,000. So further cost to completion would be 600,000. Okay. What is the contract profit in 2000 X5 and what entries would be made for contract at 31st December 20 X5? Okay. So we have to find two things. contract profit in 2005 and accounting in 2005. They have not given any details as to if we got any amount, right? Okay. Okay. How will you attempt such question? So this is a construction thing, right? So how to attempt this question? We'll go step by step. Step one is you have to see what is the profit and loss in overall contract. Okay, because they have to only find contract profit in 20x5. But if you remember conceptual framework, if you know a loss is happening, then record the loss immediately. Right? If it's a profit, then let the profit come over, like take its time and come. So that is going by the problem. So first of all, you have to write where see if the overall profit and loss. So what is the overall profit and loss? Total contract price is 1.5 million, and total cost is I have already incurred 600,000. I expect to incur a 600,000 more. So total cost is 1.2. Profit or loss is going to be a profit. First of all, we have to understand that we don't have to give a provision for loss for 2000 X6 or anything, because it's overall looking at a profit situation. Okay, that's pretty reassuring. Once you see that it's a profit account, now we have to step two is how we have to record the revenue. Now you tell me what is the performance obligation here? Let's put this five methods into consideration. What is the let's assume that we identified the contract. Second is performance obligation. What was the performance obligation? Performance obligation is construction of the contract and handing over by 31st December 20XX. Okay. So it is one performance obligation. Is it performed at a point of time or over a period of time? The information is not provided in the question whether will be eligible for provisional payments during this period, or they will only pay at the time of handover. But let's assume that it is over a period of time. Okay, let's assume that it is for over a period of time, and so there is only one performance obligation. This is delivery of the product over a period of time. Okay, now what is the contract price? Very easy. It's a fixed consideration, no variable consideration involved at all. Easy. Now, fourth point is allocate the performance obligation to the contract. So there is only one performance obligation, which is construction of building. What is the transaction price? 1.5 million. So I'll allocate this to this performance obligation. Everything is right. Now let's go to the last step. I told you it is a contract over a period of time. So over a period of time, you can record revenue if there are three things. Three conditions are given in IFRS 15. Number one is the customer receives and consumes. If you remember, he receives and consumes the product simultaneously. Here, there is no receipt or consumption simultaneously, or it creates or enhances the asset which is under the control of the customer. So we don't know if the land at which this building is made is in the customer's control or not. But let's keep it there. And the last one is the performance till date creates a asset with no alternative use for the seller, and we have right to progress payment. So let's assume that these are satisfied. Okay, if the question does not say that, and if question does not especially say that, you can make your points like this is not said. So in such a case, we can say that it is a contract over a period of time, and it satisfies these two conditions, and hence we are recording revenue till the performance. That's how your answer should be derived. Now, how do you record the revenue for over a period of time contracts? We have two methods, if you remember. There is an input method and an output method, right? So if I go by the input method, how much should I allocate? If I go by the input method, they say that we have incurred a total cost of 600,000, right? So input, it is all about cost. So 600,000 is what I incurred and divided by to date, and total cost which I budget is how much? This plus what is expected cost for completion. Correct? Any doubts there? So in input method, I see that 50% of the input is completed. Now, how do you find, and there is also output method. How do you find output method? Output method is work completed or output somebody is giving a certificate or value. Now, it was given in the question that half was completed, right? So, half is completed there. An entity can choose which one based on their policy. Okay, they can change. If they change the policy, they have to do it retroactively. So either a entity can use input method or an output method. And both for this question, it is zero point 0.5. So basically, 50% of the contract is done, and this creates or enhances an asset controlled by the customer. Let's assume. So in such a phase, we will record revenue amounting to how much? 50% of the contract price. Yes. So revenue is going to be this one. What is going to be my cost? So revenue we have calculated. Now step three is find the contract profit. Okay, what is the contract revenue which we computed? It is 750 million. What is the cost of goods sold that you will do? So what is the cost incurred till date? It is 600,000. So end of the day, your profit, contract gross profit is going to be 150,000. So we did this one. And how to do the accounting? So accounting is going to be revenue. Sorry. Uh, see, basically, how did we get any amount from the customer? Amount received. We didn't receive any amount. The question does not say any amount received, any progress payments that we received from the customer. So in such a case, what is the amount received? Or what is the revenue recorded? 750,000. What is the progress payments made? It is nil. So what the remaining that we will have as a contract asset? You remember contract asset? It's a contract cost that I incurred, but with I can get it back. Okay, which is recharge. So I will record a contract asset for this. So what would be the record accounting entries? First one, contract asset is 750,000 and revenue is 750,000. Then either it is then there is cost of goods sold, which is going to be 600,000. Whether it is paid, what is it, paid or paid, cost incurred. So let's say that bank or AP is going to be 600. This is how the entries will come, and this is how you have to see how it is done. It's pretty simple. Let's see the answers. This is a contractor where the performance obligation is satisfied over time. The entity is carrying out the work for the benefit of the customer rather than creating an asset for its own use. So it is this one, enhances or create asset, which is controlled by the customer. We can see this from the fact that the certificates of completion, complete work completed have been issued. The amount of payment is entitled, to corresponds to the amount of performance completed to date. In this case, contract is certified 50%. Measuring the progress under the output method at 31st December, the entity will recognize revenue of 750 and cost of revenue or cost of sales of 600,000, leaving the profit of 150. Get it? Hmm? The income and the expenses will be recognized in the operating category of the statement of profit and loss. The contract asset will be revenue recognized to date, that is 750,000. Contract asset is 750,000. We are not told that any amount has been invoiced. So none of the amount is classified as receivable. Correct? We cannot leave it as a receivable because we have not made billing at all. So it would be a contract asset. Okay, a cost incurred for which there is no billing that we do. Okay, so this is how you will be presenting it in the financial position. Contract asset revenue recognized less amount invoiced. Contract asset receivables unpaid invoice. Contract liability. Contract profits. This is just presentation. Okay, this question you can do 5.4 by yourself because it's just the direct application of what we did. Okay, so yeah, you have two questions on construction contracts, but only thing is just remember the steps. First thing is you see whether it is an overall profit and loss. If it is a loss, then recognize the entire loss of the current year. Okay. Then if it's a revenue, then you understand the revenue, you take it input or out. First, you have to see whether it is a contract to be completed over a period of time. If it is, then which condition, and use input or out method to kind of find out the revenue, understand the contract profit, find the contract asset. Okay. So these two questions I leave for you. There are answers also. And that is it. So this is all about revenue. Okay. So you can do this question number 5 also. It's just introductory level for 30 marks. So you can try this as well. And then tomorrow we will go to the next part. You can do one thing, either you can kind of continue the discussions and go to IAS 16 or 16, 20, 40, 23, or we can do some questions on IFRS 5 based your preference, whichever you want. Okay, so let me know tomorrow. So as discussed, 3 classes and this standard is done. It's simple, but you have to go through to understand slight nuances and pick these nuances from the question. So that makes you all the best and abreast for this exam. Okay. Any doubts or anything you want to discuss? Is it clear? Okay, so we will wind up for today. And tomorrow you will let me know whether we have to start with 4 because chapter 3 is done. You have to go with 4 or we will do some questions. Okay. Yeah. Thank you guys.